liquidity. It's more expensive to trade right now. And so I find this interesting where you have less liquidity actually in the bond market. With the next couple of questions, I'm just wondering, as insurance companies, when you're looking at your liquidity, what would be your primary measure to say, well, we're liquid? There's a couple of ratios, like the quick ratio and current ratio that they invest use. You have your just cash and your line of credit. Somebody mentioned, the Federal Home Loan Bank is a cheap way of getting credit. Is it just looking at cash flow? And I tie this, and this is just sort of, I'm just interested to hear this, but in Marco's presentation of the primary objectives you would see in investment guidelines, liquidity usually is a guideline, and I think it was 0. Mark, are you out there, by the way? I'm just like, yeah, okay. It was 0. So as you have the bond market, as you have liquidity kind of leaving the bond market, actually insurance companies right now seem to be pretty flush liquidity, relatively speaking. It wasn't even a concern to anyone in the survey, and it's consistent with what I've been seeing. And what I just wanted to open that up to is just some commentary on, why is liquidity not important? I kind of think I know the answers, but I'd like to hear it from some people who are actually doing operations. Why would liquidity be so important? DNA, okay. This is where I'm putting the pressure on you. I could have come up with 5 answers for you to answer, but I was looking for creativity. All right, Collins. Those are Collins. Most of the things have to do with, generally, your fixed income portfolios are somewhat aligned with your cash flow needs that you're going to have maturities, or just the nature of insurance where you're bringing in premium today and you're paying claims down the road just creates cash flow. So a couple things of that. I think a couple presenters talked about, you can look to trade a little bit of liquidity to get investment income. I think Marco talked to some asset classes where you can do that. I think some companies have already done that. The flip side, though, is this is just a disconnect I hear between sort of our investment team and clients. We definitely want to have more advance notice if we do have to raise cash for clients. It's an infrequent thing, but sometimes you have large payments for dividends or reinsurance payments. And we really do not like to be surprised going out into the market. I mean, we can always sell bonds. It's not a function of not selling. I'm moving it along as fast as I can. I'm going there. Still got, we're way ahead. So anyway, this is just something, again, it's interesting to me. There's a disconnect where my trading desk is kind of complaining and unhappy about liquidity. Clients don't seem to really be concerned about it at all. Credit risk. So again, this is just one of those definitional things. I think Marco hit on a couple. I think Greg might have hit on some of it. When you think of credit risk, what's your primary definition? Is it credit spreads widening? Is it your average portfolio credit rating? Is it downgrades, especially below investment grade? Are you thinking at the level of, well, what's my default and recovery rate, or is it other? Because these are all part of credit. Credit risk is really an overarching description of all of these. Yeah, it's interesting. I know Marco talked to the credit ratings, sort of average credit ratings is what we use, but credit spreads are probably a better indicator. Do you want to follow up on that at all? I just thought that was an interesting discussion.
Yeah, I think the point I was trying to make there was we all use the rating agencies, Moody's, S&P, Fitch, to kind of calculate what the average credit risk in our portfolios are. And the point I was making there was, in addition to that, a good way to really see what the credit risk of your portfolio is compare the spreads of your securities to a basket of single A rated bonds that are trading at 75 basis points over treasuries. If you have a single A rated bond that's trading at 120 basis points over treasuries, that bond's going to triple B. It's not going to remain in single A. And vice versa, if you have a triple B bond trading at 75 basis points over treasuries, good chance that the credit metrics there are improving and that bond gets upgraded. So it's a way, I think, a further way to really highlight and dig deep into the credit risk of portfolios.
And the fact that the answer C is number one, that doesn't surprise me. All I would say, you've probably looked at it, but try to work with whoever's managing your bonds to be sensible about how you handle that. For insurance companies, buying that triple B space is very challenging because you're right at that cusp of going below investment grade, and that really matters to a lot of companies. At the same time, you don't want to be a forced seller. You don't want to be a company that is panic selling when something might get downgraded, or when it gets downgraded, selling automatically. One of the things you can look at are the yields and the credit spreads and the price of the bond to really evaluate. Sometimes a double B rated bond, now I know it carries bigger risk charges for various accounting, but sometimes that bond, from the market perspective, might be a better credit than a triple B rated credit. Just again, another definition, protection of capital, I think, was the number one guideline. What's your capital? Is it statutory capital, and bonds are held at amortized cost? Is it equity mark to market, which you could also call economic value? AM Best has their own version of adjusted capital, where it's sort of mark to market, but then they do it after tax, and then they also cap it for a certain variety of up, down, and interest rates. I think, again, just interesting to me when you talk about protecting capital, make sure you know what your measurement of capital is. And my concern with this, and it continues to be, because it feels like we come here with rates at the same level every year, is that everybody that's saying statutory surplus is the number one measure, when if interest rates go up and all the unrealized gains become unrealized losses in the bond portfolio, all of a sudden B is going to become, or C is going to become very important. So I figure most of you have thought through that, but it's very easy for it to be A when it's unrealized gains. You may not like the answer A so much. It'll help you accounting-wise, but when all those unrealized gains become red or have parentheses around them and become negative, that's going to be the real test of if you believe in statutory accounting. So what factor most determines your fixed income duration? I think it's probably a little of A and B and maybe C, but I'd like you to just pick A or B, not it's actually a little more competitive than I thought it would be. I really thought B would be the dominating answer, just because it's a little more in the world of risk management, but also with rates so historically low, it's pretty hard to ignore where they are. Of course, the problem is if you really, if you were betting that rates went up and you've been betting that, I think I've been doing this 7 years now, and rates have been low and about to go up for 7 years. was kind of dreading this, just dread speaking, but dreading this and that. I really feel like I could just put a tape recording on it 4 years ago and talk about it. But that's actually interesting. That's a higher number. That's a more influence on the current level of interest rates than I expected to see. Again, trying to get specific, you know, everybody dislikes low interest rates, but why? Actually, A is a positive thing. I mean, low interest rates have clearly created some asset value appreciation, not just your bonds, but probably equities and all, and there's concerns about asset bubbles. Everything else is a negative. Getting very specific, a lot of companies use their income to just, they pay their dividends or expenses. C is more of an actuarial issue. For a property casualty company, you know, you're discounting your rates, so now your rates are going to be higher with a lower discount rate. You know, life insurers, especially if you have some sort of annuity with guaranteed rates, you can't meet it. Net profit is just net income. You know, bottom line is you're producing less income. Surplus is related to income, but I think a surplus is, you know, it's your balance sheet item versus your income statement item. And then you have other. So it's pretty well spread, but it's very interesting actually the number of respondents where the interest rate is actually flowing into the underwriting portion. It's actually affecting the insurance business, where that's really the big negative. That strikes me as kind of interesting about that. So, as I said, we've been talking about low interest rates for 7 years. So, at this point, what's your expectation? Do you still think you can make changes to add significant value in terms of income? Are there still marginal changes left? C, at this point, you've done all the changes, and any additional changes would be too much risk or reward. Or D, you know, at this point, really, you're waiting for rates to go up. I don't know, I'm not tracking who's answering these, so I'm just wondering at this point who's really sitting here going, well, we can talk about this, that, and the other thing, but I just need rates to go up. I'm really dependent on the market. Okay. Well, the good news is B, and hopefully some of the other speakers, you know, brought some ideas today. You know, that can still add some marginal value. And do it in a way that's risk appropriate, that you don't feel like you're stretching too far. I appreciate the 11 people who answered D, although we really just need rates to go up. That would really just solve a lot of things. Again, just open to questions and comments. I just talked about the investment objectives, tried to get some definition on credit risk, talked about income. Is there anything specific somebody would like addressed on those issues? It's 4:37, so we're still got 20 minutes, and I don't think we use it. So C, what happened to A and D? They were really popular last time. Okay. D, thank you. So this is the last section. This is just sort of a mishmash of questions that I came up with while I was looking at different presentations. This is really focused on property casualty insurers. In Marco's survey, he talked about all the various additional things that you need to do in addition to managing the investment portfolio. I picked 4 or 5 of the ones I thought were what I usually see are important. I was just wondering what you think is important in addition to managing portfolio. Wow, asset allocation. You know, and certainly, there's been plenty of studies out as far as the percentages, but you know, 80%, 90% of your return ultimately it comes from the asset allocation. Not surprisingly, with liquidity, nobody cash flow testing that a real concern.